Thought we'd take a look at REA Group after they're reporting a bumper 37% increase in half-year revenues. More to come as 2022 promises to be another big year for the online property group. Shareholders will get a very healthy 75 cent per share dividend, despite management expecting an increase in operating costs. Company also targeting full year positive operating revenues and also including Mortgage Choice in their armory as well. Stock's down a touch today. Came out on the day that News Corp reported pretty decent results as well. Claude, what do you think of REA's result in these COVID times? Property has been on a tear, has been hot. I suppose it's been a beneficiary.
Yeah, I guess it has been. And I thought the result was actually really quite strong. And I was a little bit surprised to see that the stock didn't move. Perhaps, I thought it might be up a little bit on the result, to be quite honest, even though this is a much larger company than I usually invest in myself. I don't invest in a mega cap like this one, but it is a high quality blue chip business that has a identifiable moat that should be durable for many years. And it has presented what I understand to be quite strong results. Even I thought it was a touch above what the analysts were expecting. So usually for a large company like this, I would have actually thought to see it notch up, but perhaps it's fighting against the fact that I guess growth stocks and high multiple growth stocks have really been coming down a lot lately due to inflation fears. So, on the one hand, you have great, strong underlying performance. From what I've read so far of this result, I haven't obviously had a long time to analyze it, but I think it looks really strong. This has been a strong business for many years. This was another strong result. The underlying business seems very healthy, seems to be going very well. But of course, share prices will go a little bit too far to the upside and then a bit too far to the downside. So maybe what we're seeing now, the bigger picture is that perhaps the share price got a little bit ahead of itself, and now its fundamentals might have some work to do just to catch up to bring the share price back up.
Would you be a buyer at these levels?
So obviously for me, I prefer high risk reward small caps, but yeah, look, I do actually think that REA Group is probably something reasonable to buy in a diversified blue chip oriented portfolio. Yeah.
Okay. Luke, what do you reckon? See, my fear of this was the property market was too hot. They make their money not only just on people listing their property, but paying a premium for the position they get and the length of time that they have on the platform, which I thought, gee, everyone's flogging their property pretty easily. Why would you pay a premium? And the listings won't be there on for a while. So it actually did a whole lot better than I thought.
Yeah, look, Koshi, I agree. And that was my fear with REA sort of last time I looked at it a few months ago. I sort of questioned where's the growth in the business, because you outline those drivers. It's listings growth and sort of the additional revenue they can generate by shifting people to what they call their premier options. And it seemed like listings growth, we'd had a hot market and maybe we would be in that sort of, 5 to 10% listings growth. It looked like REA as a business had gotten pretty close to tapping out that premier conversion as well. That was up around like 85, 90%. And then they come out with this result, and listings growth is obviously 17%, which I think is above normal and maybe where you see a bit of apprehension in the share price. People expecting this could be a little bit of an over-earning sort of report. But fair play to the business. That's out of their control. What is in their control is they then generated even more of that conversion to Premier, just as you think maybe that's starting to top out. So you go from 17% listings growth to 25% organic growth as you generate that additional extra. Always been a brilliant business at managing the cost base, so you saw leverage all the way through to earnings. Valuation's the only thing you can sort of point to as a potential negative or something that sort of goes against just owning this stock or buying this stock outright. It's right up there, 55 times earnings. And like I said, there's a chance that those earnings could be a little bit elevated given the macro we're in with housing and does that start to just cool down a little bit. I probably agree with Claude, though, for the right investor. And this isn't me or Claude. We both outline that. We focus more on that smaller end of the market. But if you're someone who just wants a sleep at night portfolio, like REA, and I think even being down a little bit today, Claude touched on it perfectly there. It's just the fundamentals backfilling where that price has gone, probably post-COVID. So I think it's a buy as well for the right person who understands that it probably won't give you, 35, 40, 50% a year. It did that coming out of COVID. Now it maybe consolidates to a more steady income. But it's such a quality business. I think you can definitely own it for the longer term.
I love the way how you two do that because, it's not in your wheelhouse, but you can understand every investor has a different wheelhouse. So for a blue chip, good sort of self-managed super fund, low risk, maybe it's appropriate for it. So it's good to distinguish that.